it should bounce, new highs is the target, trend continuation, right? So that's using fib retracement as a confluence. And, you know, if you wanted to just test it in a basic sense, you could buy directly on the 382 with a stop loss below the 618. Now you're going to have to put it, not just right at it because you could touch it. Maybe you pick an area, maybe you draw another measurement tool and you put it 10% below or 20% below or whatever, draw from top to bottom. But up to you. Play around with it if you like. I'm not a big fib user, but it's definitely one that's useful or potentially useful. And a couple of notes on some other things. Other confluence tools you can use. Support and resistance. I kind of talked about this at the start, right? If you're looking at like here, for example, this is support, right? Isn't this support? So didn't it also just do a trend leg up and then the bands went bullish and then it pulled back into support and support held, right? The low, the test, support held and went new highs? Yes, it did. However, any of you boot campers will know, I just said support. What does that even mean? Why was that support? Right? Why not this? Why not that? Why not this? The problem with support and resistance is that it's subjective. You have to define what it is. If you can't define clearly what it is, you're going to be left confused and more prone to error. That's why even something like a fib retracement, at least that's objective. At least it's an exact number. That's why the moving average itself is an exact number, right? It obviously is dynamic, but at each moment, it is at an exact price. And that's why things like market structure, right? Your BOSs, your market structure breaks, to confirm, they cannot be fucked with. The market structure break is this. It is nothing else, right? It is if you go to your lower time frame, well, not, but the market structure would be here, right? That swing high before the lowest point, when it breaks above it, that is an MSB, so it can't be anything else. So you want to keep things as objective as possible. So a lot of people like to say, well, I'll buy the pullback into support. You have to find a way of defining support that's completely objective. And liquidity. Liquidity is another great one, which I am a big fan of in other forms of trading. Liquidity meaning it goes like see here, right? That's liquidity. There'll be stop losses there. It hits them. It reverses. So you have that false breakout initially. That's liquidity. So price grabs, stops, or goes above a high or below a low and reverses. That's the false breakout. The problem again with liquidity is what? Daily liquidity, 4-hour liquidity, the swing high, the swing low. The problem in a pullback is your swing high is really clear in the pullback. It's the highest point. Your swing low, because it's a trend, ideally your swing low won't break because it's a trend. So then which one do you use? Do you use the last daily low? Do you use the weekly open, the week or weekly low, last month's, last week? It gets a lot into too many different options. So I think in terms of keeping it simple, better to just have it as the something like volume, RSI, fibs, data, combined with market structure. Not to say you can't use support resistance, not to say you can't use liquidity. They're just a little bit harder to define objectively. All right, now, next. So that is primary, secondary, tertiary, market structure, confluence, done. Invalidation. Invalidation, I think this one is taking profit, right? Yeah. Invalidation is not really something I need to cover super in depth because the short answer is you just have to choose what invalidation is going to be. So your invalidation for this, let's say you got in based on your fib retracement and market structure, whatever, and it's broken there and you get in there and it's touched the 50. Your invalidation there is either going to be this low, because if I zoom into a lower time frame here, right? If I zoomed into the 1 hour and we looked at this and we took all this off and it had pulled back into your 50 period EMA on the 4 hour, and you took this swing high there and you were looking at this downtrend, this is a downtrend, right? Lower highs, lower lows, lower highs, lower lows, then boom, market structure break. So if there's an MSB and you've had the 4 hour primary retest, then it should not go below this low. Otherwise, this wouldn't be an MSB. So it's an MSB, so it should stay there. There's your invalidation. So that's one, which is, I always think is the best market structure. Secondly, you could use the bands themselves. If you're buying at this band for whatever reason, you could put your stop below that band like I showed earlier. And What else for invalidation? I don't really think you need to go much beyond that. Either market structure or the next band down tends to be the best. Right? So market structure can also be you could say a swing low or a swing high in a uptrend or a downtrend. And those are really it. I don't think there's much point going beyond that. Now, take profit. This is where there's a bit more nuance. A few ways to take profit. I'm just using the bands here, for example. All right, here's an example of taking profit using primary full cross. What does that mean? Okay, you get into the trade because the bands are all bullish. So 50 is above 100, above 200. So you buy. Okay? Just hypothetical. The reason you exit is when they do the opposite. So they're all bullish, 50 above 100, above 200 cross. You wait and wait and wait and wait and wait and wait and wait until the 200, 150 cross. Meaning the 200 is above the 100, which is above the 50. And you exit there. At the first point at which they are in the complete opposite order, that's when you exit. And you just exit the full position there. That's primary full cross. That's the simplest. That should make complete sense to everybody. If you're in because they're bullish, you're out because they're bearish. Yeah? Cool. Next. Where is... Oh, get fucked. What have I done? I had my secondary full cross. Maybe it was on a different chart. I'll just do it again. So the second way is to exit on the first cross. So the entry was around here. Let me just do this again. I don't know why that deleted, but your entry is going to be around there. Your stop loss, same place. Now, a second way of doing the take profit would be when the first cross of the 50 and the 100 happens. So you're looking at the first point where the 50 and the 100 cross, which is over here. So you can see it here. The 50 is above the 100 here. The 50 is below the 100 here. So on this candle. I know it's hard because you can barely see it, but rules are rules. This is exactly where the 50 and the 100 cross for the first time with the candle close. That candle close is exactly where you exit, okay? Which is there. And down a little bit. And that'll be your exit. So the first one was when they're all bearish, which will obviously take longer. So you're going to sit in the trade for longer. This one will get you out of the trade sooner. Sometimes it will get you out with more profit. Sometimes it won't. But it will always get you out sooner because the 50 has to cross the 100 before they all cross. The idea of this is saying, okay, probabilistically, because we had the uptrend, if it's starting to cross, it might bounce, it might not go, it might go higher, it might do everything, but it also is a sign of the trend weakening. So you're out there, okay? That's second type. So primary, full cross, primary, time frame, first cross, 50 and 100, and the third way is your secondary full cross. So the primary trend is the 4 hour. This is now on the 1 hour. And so you're waiting for the 1 hour to fully cross bearish. This happens even earlier. So over here, you have some parts where the 1 hour is partially crossed, where the 50 crossed 100, but it does not cross the 200. So there's no exit there. It goes higher, 1 hour trend again, And you wait and wait and wait and wait and wait. 50 crosses the 100. 50 crosses the 200, but the 100 is still above. You wait for the 200 to be above the 100, to be above the 50. That's here. You exit there, right? So that one gets you out even earlier. If I compare these side by side, you'll see this. And if I put this to the 4 hour, it should be even clearer. There you go. So in the first example, waiting for the full cross, you enter on the 4th of Feb, you exit on the 18th of April. The second one, you enter on the 4th of Feb, you exit on the 23rd of March. The third one, you enter on the 4th of Feb, you exit on the 16th of March. So you get an earlier exit each time. You also get the best returns on the third one, marginally, but if you do this across a series, it quite often turns out to be much better and get you out earlier. Now, the problem, I guess, or the risk or the potential risk of this is that sometimes something like this could happen, except it does cross earlier, like here. There could be instances where the 50, 100, 200 on the 1 hour cross here and you have to exit there, and then you're exiting probably too early in the grand scheme, and you might exit with a 2 hour. Right? So there is that potential. That's why you test these, run these things through testing, okay? Last thing then I will look at is RSI. And if let's just imagine you're in that exact same trade. Your rule to exit could be an RSI divergence followed by a market structure shift. So what would that look like? You would be looking at a bearish divergence to form. So you entered over here, 4 hour goes up here. This is a 4 hour bearish divergence, right, all the way along. But that's not a reason to exit. The reason to exit is the divergence and the price trigger. So you've got your divergence confirmed here. So the divergence is basically confirmed at this point. Then you're looking at your swing lows. There's swing low, doesn't break. There's a new swing low, doesn't break. Moves up into these highs. This swing low does not break. So you don't actually exit this trade at all at this point. Even though you got your RSI divergence, you don't exit because there's no market structure break. You would have to wait for the MSB. Then it continues higher. Again, you're still looking for the same thing. So you get a RSI reset, like I showed earlier on for an entry. So you might have even got an entry there. Then it goes up again. Then you get another RSI bearish divergence right over here. Peak to peak is lower. Then you're looking at a swing low, break, doesn't break here, right? Swing low for the high, doesn't break, wicks down, but doesn't break it. Goes higher and higher and higher and higher and higher, and you're waiting essentially at this point, you've got your RSI divs, then it goes back to 50, then it comes up again, so that was a reset, then it comes up again, then it does another divergence here, and I think finally you get the fucking exit over here, which is price goes higher, RSI goes lower, and you are then looking at your swing low, which would be this point, this low that leads to this high. When that breaks, out you go. Right? Then you're out. So by using RSI in that example, you actually get the exit closest to the top. Now, don't rush off and everybody think that this is the greatest system ever existed. It worked super well there. It might not work like that all the time. So again, test it. Yeah? Cool. And that is it. Well, that's the majority of it anyway. So, G fucking M. All right. Let's go. Questions. I'll answer a few questions and then we will finish up. Hope you've all been taking notes. Asher, when using 3 time frames, for example, use secondary and tertiary for confirmation early entry, does it matter which time frame should be best used for identifying market structure break present in the trade? I answered that already. Or do we need to do the same primary plus confirmation, secondary, tertiary, and smaller time frame reverse while higher time frames is in continuation? Yeah, I actually, this was exactly covered here. Last night I actually did this, right? Market structure tip. Your primary trend is here. If you have your primary trend, higher highs, higher lows, higher highs, higher lows, there's your structure level. Even if the market forms a downtrend on a lower time frame here, BOS, 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 until that level breaks, it's not actually a trend shift, because what can happen is this. It's higher high, higher low, higher high, higher low, higher high, higher low, higher high. It's breaking structure and having a downtrend on a lower time frame, but your swing low does not break and price continues on. So generally, you're wanting to wait for a market structure break on your primary time frame. Generally. Another way as well, which actually I think aligns with this move over here. So if you're looking at a market structure break and you're watching this trend as it develops, okay, and let's say you're swing long over here, right? You swing long all of this because of the 4 hour trend. Swing long, swing long, swing long. No market structure breaks. No market structure breaks. No market structure breaks. And then you get a market structure break here. Even though this one actually does end up exiting quite well, you can often wait for the bounce if the bands are still bullish. Because as it goes down, those bands are going to get bought. So quite often you can actually exit on the next bounce after the MSB, which just means, maybe this is a bad example because you would exit there anyway, but there's plenty of examples of, let me show it like this. I'll go to the daily because I know this happened in 2021. Here's a really good example. This is a super strong daily uptrend, but we have a really clear market structure break over here, right? That was your swing low that led to this high. That breaks, and obviously the candle close that confirmed that would be here. So you could exit there. You could also, and this is worth testing, you can also say, well, because this is still in a full daily uptrend per the bands, these should get bought and there should be some kind of bounce and you can exit on the bounce. Now you have to define, what does that mean? How do I exit? Where do I exit? Do I wait for a lower time frame, double confirmation of an under over or over under? That's up to you. to you. But if your primary trend bands are still bullish, but you've had a market structure break, the structure break gives you the early warning sign, and you get out on the bounce. This is like the best possible way to trade trends when it plays out, because what you have, it's almost like you've got insider information. I don't know, it's the wrong way of saying it, but just imagine, right? Imagine there's two traders. Both of you trade the bands,